PepsiCo, ticker symbol PEP, is an American multinational food, snack, and beverage company. They own iconic brands that are loved across the world. Whether it's Pepsi, Mountain Dew, Gatorade, Doritos, or Lay's, you will see a PepsiCo product at nearly every grocery and convenience store. PepsiCo is quite literally a staple among consumers, driving big profits for the company. The stock is a dividend king, meaning it has over 50 years of consecutive annual dividend increases. These dividend payments, along with ample capital appreciation, have generated a strong total return for investors. The company's stock price has fallen over 17% from its recent high, leaving many investors to wonder if now is the time to buy. In this video, I'm going to analyze PepsiCo's history, business model, stock financials, and the latest Q3 earnings report. Ultimately, I will share whether I think PepsiCo is a stock to own in your long-term dividend growth stock portfolio. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoyed the video. Throughout, I'll be using the stock research tool I personally developed, which is available at dividenddata.com. Here you can do deep analysis on over 7,500 stocks, helping you find better investments. Link in the description and pinned comment. As the great investor Warren Buffett says, never invest in a business you cannot understand. So let's take a deeper look into the company's history and business model. Today, PepsiCo is a massive conglomerate of various food and beverage brands. But how did it get here? The foundation is built upon some of the most timeless American consumer staples. With Pepsi, its roots date back to 1893 when the Pepsi-Cola formula was first invented. Over the following decades, the business was formed, growing in popularity and slowly expanding across the nation. Eventually, Pepsi-Cola would be sold across the globe. Alongside Coca-Cola, they created the modern soft drink and beverage industry. The Pepsi-Cola company was a dominant pillar on which PepsiCo would be built. With food, PepsiCo has equally historic origins, this time with the tale of two chip companies, corn chips that is. In 1932, C.E. Doolan stumbled into a small San Antonio cafe and purchased a bag of corn chips. After learning the manufacturer was eager to sell his business, he bought the recipe and started making Fritos corn chips in his mother's kitchen. He sold them from his Ford Model T, forming the Frito Company. That same year, Herman W. Lay started a snack food delivery company in Nashville. He too bought out the manufacturer to form H.W. Lay and Company, which became one of the largest snack food companies in the Southeast. By 1945, the Frito Company struck a deal with H.W. Lay and Company to be an exclusive franchise to manufacture and distribute Fritos in the Southeast. This started a close business relationship working towards the national distribution of their products. In 1961, the two companies merged to become Frito-Lay. This was still just the beginning. In 1965, Pepsi-Cola and Frito-Lay reached a deal to merge the companies under the name PepsiCo. As the legend goes, both CEOs met and sketched out the deal on the back of a napkin. The goal was to leverage Pepsi's national and international distribution to help grow Frito-Lay. They also recognized the complementary combination that salty snacks and soda seem to have. This marked the foundation from which the modern-day PepsiCo was built. That same year, the combined company was listed on the New York Stock Exchange under the ticker symbol PEP for 75 cents a share. Over the next 60 years, PepsiCo would continue to grow by expanding distribution, creating new products, and acquiring countless brands. They bought whatever would fit into their core business model, even taking some more wild departures. For example, they bought 3 restaurant franchises, KFC, Taco Bell, and Pizza Hut. However, those were eventually spun off in 1997 in Yum Brands, which ended up being quite a successful stock in its own right. It's clear though that they were somewhat of a side quest away from PepsiCo's main focus. So what does PepsiCo's business look like today? The company has 7 business segments: Frito-Lay North America, Quaker Foods North America, PepsiCo Beverages North America, Latin America, Europe, Africa, Middle East and South Asia, and finally Asia Pacific, Australia, New Zealand, Zealand and China region. In fiscal 2022, 58% of net revenue came from food and 42% from beverage. 57% of net revenue was from the US and 43% from outside the US. The largest businesses are PepsiCo Beverages North America at 30% of net revenue and Frito-Lay North America at 27% of net revenue. Interestingly, Frito-Lay North America makes up 44% of total operating profit, so the profit margins in Frito-Lay are significantly higher, delivering outsized profits relative to revenue. PepsiCo Beverages North America only contributes 19% to operating profit while generating 30% of the revenue. I assume this difference in margin is due to the increased competition from the Coca-Cola Company, which is the world leader in beverages. Frito-Lay, in contrast, is the market leader itself, giving them more room for price discovery. Also, if you think about it from a fundamental level, chips are far easier to make packaging and serving size adjustments to improve profitability. We all know that joke about chips with too much air in the bag. So that's a high-level look at PepsiCo's business. But what are the actual brands that make up these sales? Many of these are some of the most recognizable brands in the world. If you haven't seen or purchased one of these, then you may be living under a rock. For example, you have Brisk, Bubbly, Cap'n Crunch, Cheetos, Dole, Doritos, Gatorade, Lay's, Lipton, Mountain Dew, Muscle Milk, Naked, Ocean Spray, Pepsi, Propel, Pure Leaf, Rolled Gold, Ruffles, Simply, Smart Food, Starbucks at Home Beverages, Sun Chips, Tostitos, and so much more. Each of these brands has countless products underneath it. With Pepsi, you have Pepsi Zero Sugar, Diet Pepsi, Nitro Pepsi Vanilla, Wild Cherry, Mango, etc. With Lay's, you have so many different flavors and styles of chips. This is a large variety in the US with even more variations across the globe. PepsiCo is constantly investing and creating new products within their brands. This is what they call product innovation. It not only helps them keep the brands fresh, but it allows them to expand into new categories. These brands give PepsiCo a massive competitive advantage in the marketplace. Consumers have a mental association with them that has been built over decades, whether it's through marketing campaigns, partnerships, or simply existing as a part of culture. People grew up seeing, eating, drinking, and hearing about them. The power of branding is incredibly important to understand. It helps protect their business from competition. Consumers would rather buy Lay's chips or Cheetos compared to some no-name or store brand equivalent product. They've had them before, know about them, and have a feeling of quality. The same goes for Pepsi or Mountain Dew. People are not likely to go buy a store brand variant. Nobody wants Mountain Lightning or some random cola. This helps defend their business from competition, forming an economic moat. That is a concept popularized by Warren Buffett. However, the power of branding is not just a defensive tactic. It can also be used as a form of offense to expand the business. For example, PepsiCo uses its existing brands to expand into new product categories. It's taking Gatorade's Fitness and Athletic Association to expand into protein shakes, protein powders, supplements, protein bars, energy products, and so much more. Mountain Dew has grown into energy drinks with its Kickstart sub-brand. There are so many examples here, and it will only continue with more product innovation. The defensive nature of their business model helps give them significant pricing power. Over the past 2 years, this has become evident as inflation was rampant. PepsiCo was able to raise prices to combat rising costs. This allowed the business to fare far better compared to lower-tier companies with weaker brands. Additionally, PepsiCo has massive distribution. This allows their products to be everywhere, deepening that brand security. This distribution also gives them a level of power over retailers as they are a sizable partner. They control large shelf space and use that influence to easily launch new products into market. PepsiCo is a fantastic business that is not going anywhere. But does that make the company a good investment? Let's analyze PepsiCo's stock from the perspective of a long-term dividend investor. To do so, I'll be using my stock research tool, which is available at dividenddata.com. Here you have all the data to properly analyze the financials of over 7,500 stocks. There is a 14-day free trial, so feel free to try it out and follow along with me as I analyze Pepsi stock. PepsiCo, ticker symbol PEP, is currently trading at $162.62 per share. With 1.7 billion shares outstanding, the company is valued at a $223.8 billion market cap. The forward-looking annual dividend per share is $5 $2.06. This makes the dividend yield 3.11%. PepsiCo stock has seen significant capital appreciation over the past decade. This is largely in line with growth of non-GAAP earnings per share. That number is actually accelerating in recent years. Revenue per share is growing at a 10-year compound annual growth rate of 3.97%. The pace of growth is accelerating with a 3-year CAGR of 9%. In fiscal 2022, the company had 53% gross margins and 10.31% net margins. This has largely remained stable even through the significant inflation suffered in recent history. However, free cash flow has fared far worse. Over the past 10 years, free cash flow has only grown at a 0.84% CAGR. This was a significant slowdown compared to the prior decade of high growth. Why is this? They have nearly doubled annual capital expenditures from $2.7 billion to $5.2 billion, driving down free cash flow. This offset the $2 billion growth of operating cash flow in that time. As an investor, I find this to be the most concerning part of PepsiCo's stock financials. They are spending a lot on CapEx. As of now, it's not clear how it has improved the financials. According to their Q3 earnings release, they made numerous investments in our brands, manufacturing capacity, go-to-market systems, supply chain, technology, and people to execute against our strategic framework to modernize the company. Time will tell if operating cash flow climbs in line with CapEx growth. Ideally, I'd like to see CapEx decline. That said, it is important to reinvest and improve vital aspects of their business, especially for an old company like PepsiCo. Ideally, modernization and more automation will increase productivity and lower cost. Despite free cash flow stagnation, PepsiCo has continued growing their dividend payment. The 10-year CAGR of the dividend is 8.38%. The most recent increase was a massive 10%, marking the 50th consecutive annual increase. Prior to that, they had a 6.98% increase and a 5.08% increase. So is this dividend payment sustainable? Well, based on historical trends and recent performance, I'd say yes. But the payout ratio is still concerning. The net income-based payout ratio is great for a mature company at around 70%. The free cash flow-based payout ratio leaves a lot to be desired. In 2022, it was 110%, with the prior 5 years being between 80 and 97%. To be fair, it is only about 56% of 2022 operating cash flow, but capital expenditures have been very high. PepsiCo is typically a conservative company, so the 10% increase must mean that they feel very confident. I would assume they expect operating cash flow will grow and they may cut CapEx. This has already started to become true as of 2023 Q3 earnings, which was just released. More on that later. In addition to dividends, they reliably buy back shares as a way to return capital to shareholders. PepsiCo maintains a strong balance sheet with $6.4 billion in cash on hand. Net debt sits at $37.1 billion, which is under 4 times annual operating cash flow. I would not say that debt is a problem for the company as of now. As of this recording, my research tool has not yet been updated with Q3 data. It should be here in the next few days. On October 10th, PepsiCo released Q3 earnings, and the results were quite good, beating expectations. Non-GAAP EPS came in at $2.25. This is up 16% year over year, assuming constant currency. Organic revenue is up 8% year over year. They raised full year 2023 guidance to 13% EPS growth, up from 12%, and maintained 10% organic revenue growth expectations. The CEO emphasized that full year 2024 is expected to be towards the upper end of long-term targets. Additionally, PepsiCo made significant improvements on operating cash flow and free cash flow. Over the past 36 weeks or 3 quarters, operating cash flow was $7.63 billion, up 20.9% year over year. CapEx decreased only slightly, staying at around $2.5 billion. Free cash flow came in at $5.22 billion, up 31.3% year over year. So it seems like PepsiCo was valid with its large dividend increase. The CEO of PepsiCo was just on CNBC to discuss the recent quarter.
I do think that as a company, we are executing better and better as we reinvest back in the business and all the things that you mentioned. I think it's a good balance of top line driving things with the consumer and then running the business better is what's leading to the great results. And that's the cycle we're in right now, is just stacking quarter on quarter.
It was another great quarter for the company, and they have remained quite strong amid inflation pressures and concerns of a potential recession. However, PepsiCo's stock price has performed poorly year to date, especially over the past month, where it's down nearly 9%. In this interview, he was asked why he thought this was. After I play the clip, I will respond to his thoughts and share a major point of negative sentiment that is being brought up about PepsiCo.
More than anything, I think it's interest rates. And I think to some degree it's dollar strength, but I would lean more into interest rates as the driver. We're like most food companies, we're a pretty good dividend payer. The yield tends to run in the 2.5% to 3% range, which back when the 10-year was substantially lower was a great alternate place to park your money. Now that the 10-year is up pushing into the 4s and almost 5, I think there's more alternative investments that bear that return. That said, obviously you don't get the growth with those that you get with us. So I just think there's a bit of rebalancing going on in that regard. And that's obviously an interpretation. I'm sure lots of market makers would have lots of points of view on that.
I think the PepsiCo CEO is absolutely correct about this being a major factor of why the stock is declining. As Warren Buffett says, interest rates are like gravity to valuations. I've discussed this in all my recent videos. It is a market-wide effect impacting everything. In the September Fed meeting, they emphasized that rates will remain higher for longer. That sent the market down, including PepsiCo. Investors largely buy PepsiCo for its safe dividend. It disincentivizes people from buying the stock for that reason. However, he brought up a good point about dividend growth. Over time, businesses like PepsiCo will continue to grow and increase their payment. You cannot say the same about these current risk-free rate of returns. Outside of this, there are still more negative stories around PepsiCo stock. For example, the rise of weight loss drugs like Ozempic leave many wondering if this will impact food companies. This story became notable after Walmart's CEO mentioned the trend. Since they have data from their pharmacy and food business, they have started to notice a slight pullback in food shopping demand among those customers taking Ozempic compared to the general population. PepsiCo CEO was asked if he thinks this will impact their business.
Yeah, I would say this. We're studying it closely, but we don't see it at all in our numbers right now. I mean, zero at this point. So I think to the degree that this gets adopted, it will likely get adopted pretty slowly over time. And that'll give us time to evolve our portfolio. People are going to want to continue to snack in some form or another. If they want more protein, if they want more carbohydrates, this is stuff that we know how to do very, very well. And my expectation is, just like we did with zero sugar, we'll be able to adopt to this as time goes on. But I do think it's going to be slow adoption, not rapid adoption.
I think he is largely correct, and the impact of these weight loss drugs will be minimal to PepsiCo's business. They certainly are not an overwhelming threat by any means. Overall, I view PepsiCo as an incredibly high-quality company that will continue to grow into the future at a reliable pace. I will continue to own the stock in my long-term dividend growth stock portfolio. However, I have not bought any of the stock since early 2021. In my view, the stock trades at a premium price relative to its growth. That said, it becomes more and more attractive the farther it falls down in price. I would certainly look to add more if there was ever a dramatic fall in price not backed up by business performance. For some of you looking to start their position, now may be that time. Currently, I own 20.52 shares of PepsiCo at a cost per share of $121.71. My total return is 33.62%. This represents 2.5% of my dividend portfolio, which you can see in my monthly portfolio update videos. I may personally own the stock, but don't trust me blindly. You should do your own research before making any investment decisions. Make sure to leave a like, share, and subscribe to the channel if this video provided value. Please check out my other stock review videos, and more are coming soon. If you want to use the research tool I've been showing throughout the video, then sign up at dividenddata.com. If the software helps you identify just one slightly better stock, then it pays for itself. Thanks for watching.